Problem 1129 on page F497 and 498 is basically just a list of financial ratios to complete. As reference for this problem, pages F454 and 455 contain the entire list of ratios that this chapter covers. The information needed to complete this problem is listed just prior to the problem on pages F496 and 497. Using the format on your screen, which is based upon the formulas on pages F454 and 455, the problem can be completed one ratio at a time. The first ratio, the gross profit margin ratio, divides the gross profit by the net sales. This ratio is a profitability ratio and is designed to show how much of the gross profit is being used by costs of goods sold, and how much is left to pay for the operations of the company. Since the problem calls for the ratios to be done for both the fiscal 2004 year and the fiscal 2003 year, there are two lines for each ratio on the form on your screen. Please be sure that you pay attention to the year from which you are gathering your data. The format is very simple. The gross profit is the third number down on the income statement in the book. The leftmost column is 2004, so the $4,532,000 goes on the line next to 04 under gross profit. For the sake of easy readability of statements and ratios, almost all the numbers being discussed will be entered in thousands. This means that the $4,532,000 will be entered as 4,532. There will be a couple of exceptions to this as we go through the process, but in general, the right-hand three zeros on almost all the numbers will be eliminated. The third number down on the 2003 line is $4,147,000, and that goes on the 03 line under gross profit as $4,147. The net sales for 04 is the first number in the column, and the $14,745,000 goes on the 04 line on the form under net sales. The 2003 sales of $12,908,000 goes on the next line down under the net sales. The answer to ratio number 1 is 0.31 or 31% for 2004, leaving 69% of the sales available to cover operations. And for 2003, the answer is 0.32 or 32%, leaving 68% to cover operations. The next ratio is the net profit margin ratio. It is again a profitability ratio and indicates how much of each dollar of sales actually winds up in profit. Looking at the form on your screen, the first number is net income. On the income statement in the book, that's the bottom number. For 2004, it's $494,000. For 2003, it's $658,000. Those numbers go respectively next to the 04 and 03 under the net income cell on the format on the screen. To complete the calculation, the second half of the formula uses net sales. Since net sales was used in the ratio above, I just put a formula to reference the prior entry of the number and make our lives a little easier. As you can see, in 2004, 0.03 or 3% of the sales actually wound up as profit. In 2003, it was 0.05 or 5%. As the Chief Financial Officer, I would find that reduction in net profit margin ratio something worthy of investigation. The rate of return on assets ratio is another profitability ratio that indicates how much profit is earned on the average assets that the company owns. These assets include cash, inventory, short-term investments, land, buildings, equipment, and anything else that falls into the left-hand side of a side-by-side balance sheet. The idea is that anything that the company owns should be working towards making money. If the company owns something that is non-productive, it should consider disposing of it. On your screen, the net income needed to calculate this ratio has already been filled in. The next number needed is interest expense, and that is found most of the way down the income statement on page F497. For 2004, it is $172,000 and goes on the line directly under interest expense. For 2003, it's $137,000 and goes on the line directly below the $172,000. For this ratio, we also need to calculate the average total assets. To calculate those, we will put formulas into the two cells. In the first cell, under Average Total Assets, we'll take the total assets of $10,725,000 for 2004, which you will find almost to the top of the page, and add to that the 2003 ending assets of $9,032,000, and divide the sum by 2. Again, for the sake of easy readability, the formula in this cell will be in thousands of dollars, and the last 3 zeros in each number will not be entered. For the 2003 ratio in the cell directly below the one in which we entered the formula, we will add the $9,032,000 and the $8,701,000 from the 2002 ending balance and divide the sum by 2. The end result for the rate of return on assets ratio for 2004 is 0.07 or 7%. For 2003 it's 0.09 or 9%. This drop in the ratio is again something that would bear investigation. We'll have to jump down a page to look at the next ratio, which is the rate of return on common equity. This again is a profitability ratio, only instead of comparing average assets, we are now going to compare average common stockholders' equity. By doing so, the stockholders get an idea of the return that they are going to get on their investment. Once again, a formula has been used to carry the net income down from a prior ratio, and we'll just need to fill out the rest of the equation. The next item needed to calculate the ratio is preferred dividends. As we look at the balance sheet under stockholders' equity, we only see common stock listed. It's a safe conclusion to say that if there is no preferred stock, there is no preferred dividends. Therefore, the preferred dividend amount in both ratios is 0. The average common stockholders' equity is going to be calculated by averaging the $4,389,000 at the end of 2004 with the $3,432,000 at the end of 2005. Those numbers summed and divided by 2 go under the average common stockholders' equity for 2004. For 2003, the $3,432,000 and the $2,958,000 are summed and divided by 2. The end results are that the stockholders are seeing income of 0.13 or 13% on their investments in 2004 and 21% in 2003. Something must be going on that all these ratios are getting smaller. Ratio number 5 is a dividend payout ratio. This is still one of the profitability ratios and indicates how much of the net income is being paid to stockholders in cash dividends. As you can see on your screen, this is a simple ratio. The numbers needed to complete this ratio start with dividends paid, which is listed below the income statement in the additional information section in the problem. For 2004, it was $137,000. For 2003, it was $184,000. Since the net income has already been carried down, the answer for both years here is 0.28 or 28%. I would venture to say that any retiree owning this stock would be happy to see such a regular payout. Ratio 6, earnings per share, is still a profitability ratio and is one that is watched closely by the investment community. Earnings per share is considered one of the excellent pictures of the financial health of a company. Once again, the net income has been carried down from a prior ratio, and the preferred dividend has been carried down from a prior ratio. The average common shares outstanding is listed in the additional information section of the problem on page F497. Now you need to remember that since net income is in thousands of dollars, the average common shares outstanding also needs to be entered in thousands. If you miss this step in this calculation, the earnings per share will look terrible, and the terrible results will reflect on our next ratio, which uses the earnings per share in it. On the 04 line, the 2,470,000 average number of common shares outstanding gets entered as 2,470. On the next line down, the 2,350,000 gets entered as 2,350. The results of this ratio, the 20 cents and 28 cents per share, will only reflect good information as it is compared to the industry averages of the industry in which this company operates. We'll once again need to jump down a page on the screen. The next ratio is the price-to-earnings ratio. This is another of those profitability ratios that the investment community really likes. This compares the earnings per share to the price of the stock on the resale market. The earnings per share have been carried down from the prior ratio, and the average market price for 2004 and 2003 are in the additional information section in the problem. The average market price per common share is not in thousands, and earnings per share is not in thousands, so we enter the average market price for 04 as $1.41 and for 03 as $1.83. Once again, the 7.05 and the 6.54 are only useful as compared to industry averages. The rest of the ratios in problem 11-29 will be covered in a follow-up video. To not split this problem into two would result in such a long video that some internet connections could have problems in downloading it all.